Welcome everyone. This is Kevin Davey, KJ Trading Systems, and thanks for joining me today. And the topic today is going to be think like a trader. So today's agenda, I want to talk about my big breakthrough. Then I'm going to ask you guys some questions. We'll have a couple polls, and then we'll talk about thinking like a trader. Okay, so don't trade with money you can't afford to lose. Past performance is not indicative of future results. Treat all results as hypothetical. Okay, so, if I look back on my trading history, probably the first 10 years or so, I did a lot of things wrong. It was awful. And pretty much every mistake you can make, I've made. And what it led to was a lot of in-depth research. I started looking for better ways to do things and, how to do things right and that kind of thing. And I studied what winning traders did, and, I read a lot of things. And so I combined everything together with my own personality, and that got me to where I am today. So my personality came through, and I'm very kind of step-by-step, detail-oriented. I guess it would be considered like an analytical type approach. As my personal physician says, he says, "Hey, Kevin, you're a numbers guy." And that's what he was trying to convince me to lose weight, but he was trying to use the, "Hey, you're a numbers guy." And I guess that's what I am. So you've really got to have psychology that matches what you're doing. And I think for most of you who are thinking about algo trading, you probably already are going down that path. So that's good. The big breakthrough, though, was when I actually started to think like a trader. And I'm going to explain what that means, because it's a little different thinking than how most people think. And you may not realize it, but if your thinking hasn't already changed from trading, it certainly should, and it probably certainly will. So I have a couple questions for you, and I'm going to put up a poll, and let's see if I can do this here. There's going to be 3 questions, and you can answer 1, 2, and 3. So the first question: if you had a choice between trading a strategy that won 90% of the time and one that only won 10% of the time, which one would you choose? Or you can say, "Hey, I don't know which one I'd pick." So you can answer that one. Then the second question is, what would you rather trade a 3-to-1 reward to risk ratio, or a 1-to-3 reward to risk ratio, or you don't know? And then the third question: would you trade the system shown? And I'm going to try to show that system right there. So that's for question 3. Would you trade that system? So if you can, you guys should be able to see the polls up there. If you can't, let me know. There we go. I think people are starting to answer now. And, just answer, what would you rather do? So question 1, again, is a 90% winning strategy versus a 10% winning strategy. Question 2 is a 3-to-1 reward to risk ratio versus a 1-to-3. So meaning if you gained $1,000 when you won, you'd lose $3,000. That's a 1-to-3. And then the third question is, would you trade the system shown? Okay, so I'm going to go like 1 more minute. Most of you have participated. There's more people coming in, but I'm going to shut it down in 10 seconds. Okay. So The results, I don't know if you guys can see this or not, but 61 or actually 58% of people said, oh, Zoom just gave me an error, failed to end polling. Okay, well, I guess. Okay, so 58% of people said they want a strategy that wins 90% of the time. Only 5% picked the 10% winning ones. And then 37% of people said, I don't know. And then question 2, most people picked the 3-to-1 reward to risk ratio, 68% of you. And system question 3, the system question, 74% of people said they would trade that system. Well, guess what? I'm going to explain them later, but the correct answer for all of them is C. So if you answered C to any of them or all of them, congratulations, you're already thinking like a trader. And if you didn't answer it, like I said, I'll explain it, but these were kind of trick questions, so bear with me. But thank you for answering. Okay, so thinking like a trader, what does it mean? It means there's certain performance numbers you should focus on and certain numbers you can avoid or don't even need to look at. You need to know how to dig deeper into some of the trading statistics and use the performance numbers to increase your trading confidence. And this relates to the third question with that equity chart. Looking at historical performance, is it important? How do you do it correctly? That's what you got to look at. Oh, by the way, I can share the results so you guys can see exactly how everybody voted. Okay, so let's talk about that first couple questions. A lot of people focus on winning percentage or reward to risk. And that's how you guys answered. And you know what? Both of them are basically useless by themselves. A 90% winning percentage doesn't tell you anything. If I win $1 90% of the time, but when I lose $100, that's an awful system, right? Here's that example. So example 1, you win 90% of the time, you win $1, and 10% of the time you lose $10. I said 100, but okay, 10. In example 2, you lose $1 90% of the time, and you win $10 10% of the time. Well, guess what? The 90% system is worse for this example. It's better in this case to have the 10% winning system. So the point is, if all you know is winning percentage, that's not enough information. It doesn't tell the whole story. And I came across this recently for those of you on Futures.io. There was somebody who was asking what people's winning percentage was. And I stupidly started to engage this person and answer, you know, hey, it really doesn't matter. I have a system that wins 95% of the time. And he's like, wow, that's great. And I'm like, no, it's actually not, because you don't know how often or, you know, what the size of the loss is when I lose the 5%. It could be a terrible system. And he was like, yeah, but if you win 90%, 95% of the time, that's good. And it's not. And hopefully everybody sees that. Here, the 90% winning system is actually worse than the 10% winning system. And it all has to do, obviously, with expectancy. That's the same thing with reward to risk. I can't tell you how many people say, oh, you need a reward to risk of 3-to-1, or 2-to-1, whatever. That's BS. You don't necessarily need a certain reward to risk ratio. And here's an example. So you win $3 and you risk $1 20% of the time, or you win $1 and risk $3 to win 80% of the time. This example, the bad, quote unquote, bad reward to risk ratio is actually better. Okay. So again, reward to risk doesn't tell the whole story. And I'm not saying those statistics aren't important, but they're really important when you put them together. And that's called expectancy. And hopefully people realize that you can't rely on just win percentage. Now, there's one caveat to that. If you're trading one system and it's a 10% winning system, psychologically, you're going to be a wreck soon, because it's going to be easy to get 10 or 15 losses in a row, and you're probably going to give up on the system. So psychologically, the win percentage when you're trading one system can be something to really worry about. But if you're trading 20 strategies, I'm trading 38, 39, something like that. I could care less what the winning percentage is. I care about the expectancy. And that is what you want to remember. It's all about expectancy. That is the key. And expectancy incorporates both win percentage and reward to risk ratio. And of course, expectancy is just a fancy way of saying average profit per trade. And a lot of people think, oh, I need to know the win percentage and my reward to risk. No, if you run a back test and you just look at the average trade, if it's somewhere $50 to $100 or more after costs, I consider that a pretty decent strategy. You know, you don't want something that makes $5 net, because one, you're probably scalping, which means you might have some unrealistic assumptions in your strategy. And two, there's a fine line with all the issues that come up in automated trading. And there's issues, there's internet outages, there's data corrections. And if you're only earning a couple dollars per trade, all you need is one bad trade to really wipe you out. Or your slippage is off a little bit. You get a little more slippage than you think. All of a sudden, your $5 net average profit turns negative. So you want something, I would say, at least $50. And that's for normal size futures. You know, like the ES would be $50. Obviously, if you're trading the micro ES, that's 1/10 of it. That would be $5. But I'm talking about like the normal, not the real little contracts. And along those lines with expectancy, you can also calculate something called the THARP expectancy, which takes the expectancy divided by the average loss, and anything around 0.1 or higher is usually pretty decent, because that tells you you're going to win on average 10 cents for every dollar when you lose. And you know, that's a pretty decent number. Obviously, the higher the better with that. But that's another number you can look at, which is based off the expectancy. So the big point here is you really have to dig deeper into the numbers. And again, I kind of tricked you in the beginning by just throwing out win rate and reward to risk without any more information, but that's where you'd want to dig deeper. And that's all about thinking like a trader. Traders will dig deeper and look at those relationships and figure out, oh, hey, I can live with the 30% win rate as long as I have this reward to risk ratio. That's how you got to look at it. Okay, now let's look at that equity curve. Now, a lot of people look at this and make a decision whether they should trade it, how they should position size it, when they would stop trading it. Now, most of you said you would trade this, but there's a couple of issues with that. You don't know how this was created. You have no clue. I could have optimized this. I could have literally picked buy and sell dates off a chart and put them in a strategy to get this curve. And I said, oh, I'll make it look too good. I'm going to put a couple losers in there. So it could be over optimized. It could be just manipulated. You don't know. And so again, that was I'm sort of tricking you there, but I'm trying to get you to think more like a skeptical trader. And you should look at this equity curve. And the answer is, I don't know if I would trade it. I have to figure out how this was made. And this comes up a lot for me because people who've read one of my books, people will send me equity curves, say, what do you think of my system? Isn't this great? And I'll be like, I don't know. How do I know it's real? How do I know it's not just something you created? How do I know it's not sim trading with no costs added and limit order fill issues, all sorts of things? You just don't know. And that's the really cool thing about building your own strategies and doing it from scratch yourself, because then you can trust what you get. As long as you do things right, you can say, well, hey, I use this approach, this process, and I believe in it and I know it's accurate. Because look at that bottom line. I mean, this is what the scammers out there, that's what they do. Go to Instagram, go to Twitter. You'll see people showing these great equity curves. Oh yeah, never have a losing day kind of thing. And I go and I show walk forward real-time equity curves that are pretty realistic. And people have told me, oh, your equity curves look like crap. They look, excuse my French, they look awful. And my response is, well, yeah, they're real. And if you don't want to believe it, that's fine, but you got to watch out, because these trading system vendors that are out there will show you what you want to see. And what people want to see is a great looking equity curve, but it doesn't tell you you can trade it. And a lot of people say, huh? When I say equity curves alone are junk. Hopefully I've just explained that enough that you understand that. And again, the key is to know how those equity curves are created. Heck of a lot of difference in these 4 different methods. Obviously, if I had to pick one and say which is the best, you show me an equity curve with live trading results, that looks good. I'm going to do that one first. Walk forward testing second, out of sample testing third, and I'll say fourth for fully optimized back test, but really I'm saying never, should never rely on an optimized back test equity curve to do anything. And most people, that's the one they do. Why? Because out of sample testing takes some effort. Walk forward testing takes even more effort. And of course, live trading takes real money. And nobody wants to just go start trading a system that they haven't tested, right? Just to get those live trading results. But that gives you the best, obviously. So if you don't want to settle for this, or you can't do this, which most people can't, then really, in my opinion, you have to go with walk forward testing, which when you do it right is really good. The other thing about the equity curves, you didn't know how many rules and variables are in them. You know, maybe it's one rule. It's a simple, if this buy, if this sell short. Maybe there's 100 rules and tons of variables. You don't know. And that's the point. Curve fitting is really easy. So the rule here, and I hope you walk away from this believing this and understanding it. Doubt every single equity curve you ever see unless you created it. And even the ones you create, question those too, especially if they look too good. My second rule here is if it looks too good to be true, it probably is. And because I'll tell you, I sometimes develop strategies and I get this great looking equity curve, and there's two ways to think about it, right? One is I just found the Holy Grail, and two is I probably screwed up and did something wrong. I want the first one to be true, but usually it's the second one that's true. I usually screwed up something. And there's a ton of different ways to screw up, and that's part of what I teach in my workshop, but it's all about creating a strategy the right way. And when you do it, then you can rely on that equity curve. So back to that equity curve question, let's go back. Here it is again. If I told you this was developed with my strategy factory process, this is all walk forward data with maybe the last 15 trades being real-time performance, then it would be totally legit to say, yeah, I would trade that because I know how it was built and I know what went into it. Then I'd believe it. So that's the way to think about that. The other part of equity curves is position sizing. And you can't really position size just based on an equity curve, because the equity curve would look great. And if it does look great, it's going to tell you basically, put all your money into it. What you never see in that final equity curve is what potentially could have happened. Yeah, maybe the equity curve looks like this, but maybe it was a few favorable ticks here and there. And if you didn't have those favorable ticks, maybe it would have done this sort of thing, you know, where maybe it was like a couple trades, 3 or 4 trades difference makes a world of difference in that equity curve. You don't know. And so that's what I mean by potential. That if there was the potential for loss, that could have happened. And I guarantee when you go live, those potential losses that never showed up before will start showing up. The equity curve always has some bit of good luck built into it because it survived all your tests. And that's pretty much the way it is. But when you go live, guess what? Good luck usually disappears. And a good example. So let's just say you have a strategy with this huge stop loss, $10,000, and it's never been hit in historical testing. Well, don't position size forgetting about this possibility. Just because it's never happened doesn't mean it will never happen. And if it could happen, you should at least be able to withstand it, because that's what your system says, right? Your system says you could have this loss. So you got to be careful with this. Most people say, well, it's never happened, it never will. So thinking like a trader, like, well, yeah, it's never happened, but it could happen because that's what my stop loss value is. So I better make sure that I don't position size too aggressively, or else I could get wiped out by one trade if I hit this big loss. And I always get a lot of laughs with this little thing, looking in your side view mirror. You know, drawdowns are always larger than they appear. So drawdowns in the future are always going to be larger than they show up in real trading historically. So you have a system and you run the historical back test. It could be real trading or whatever, and the max drawdown's $5,000. I could pretty much guarantee going forward, if you keep trading it long enough, you're going to run into a larger drawdown than $5,000. So you got to keep that in mind. And the point, again, you dig a little bit deeper into the results. You just don't rely on what the actual trades were. You also realize what they could have been. And it's all about putting this together as part of a process. You know, you have your trading ideas that build strategies, you analyze the results. That's where we really spent most of our time today. We've been talking about analyzing these results and looking at these numbers, digging deeper, thinking like a trader here. And hopefully that leads to making some money in the market, making a good risk-adjusted return. And if it does, you gain confidence, and then it just builds upon itself, and it just kind of keeps going round and round. But if you don't do this, it's going to be very hard to get to that next step, and it's certainly going to be pretty hard to gain confidence in what you're doing. So you really want to take a close look at numbers and analyzing the results. Start thinking like a trader. Okay, so what do good traders do? First, you know, they create strategies the right way. They have a process. And then it's not about absolutes. It's about probabilities. And I showed you, a couple examples of that earlier. The problem is most people like black and white, and they don't like the gray. They like watching whatever channel Kramer's on, and he says this stock's going up tomorrow, or he says this stock went up today because of this, where he sounds so certain. But the fact is, he really doesn't know for sure. He's just trying to sound intelligent and trying to sound like he knows. I remember I was a candidate to speak at some conference in Hong Kong, and they wanted to know, well, what's your view of gold for the next 6 months? And I answered honestly. I said, I have no clue. I said, I just do what my algos tell me. And if they say be long and then be short, that's what I'm going to do. I have no idea. And guess what? Nobody has any idea. I mean, if they could, they would use that knowledge to predict the future, and they'd be bazillionaires in very short time. Nobody can predict the future with any certainty. And I always like the example there's a photo out on the internet of a fortune teller, their shop, and there's a big sign. It says fortune teller, we predict the future. And then there's a sign on the door that says out of business. I get the biggest kick out of that because, hey, wow, you were a real good fortune teller. You couldn't tell you were going out of business. But the point is, there are no absolutes. It's just probabilities. Okay, well, you have a certain probability that these trades are going to work out, but it's not 100% certain. Earlier this week, I did a video on back tests and said, well, hey, just because you have a profitable back test doesn't mean you're going to have a profitable real-time performance. It helps, but it's far from certain. So you can use past performance to make some decisions, but you got to realize there's still probabilities involved. And I think a lot of people get kind of off track because they think if they build one strategy and it's made money in the past, it's going to keep making money in the future. And that's not true. Maybe there's more probability that it will if they did it right, but it's no guarantee. And the last point is, as you start to do this, do what good traders do, developing strategies, you start to develop your own confidence. That's what's really important. Okay, so the reality for most people, they have this back test that looks great, and then look at this point is really like right here. And then this is what happens when they start trading with real money. That's what happens with most people. And it's happened with me too. So it doesn't happen anymore for the most part. I probably still have some that fail, but a lot of times the ones that what I consider fail just kind of do this kind of thing, go apart. But I mean, you can definitely have ones that look like this, and that's frustrating. It's awful. And that's where I can help. I can help you build strategies the right way where you can start to begin to create your own strategies. Okay, and if you want more information on that, my website has it. I don't want to necessarily make this a sales pitch. I wanted to make this an informative education event, but there is more info out there if you want it. So to sum it up, you want to think like a trader. Don't focus on one number. Like I showed you, focus on multiple numbers and how they interact. Dig deeper into some of these statistics and take a look at things. Be skeptical of what you see. That's part of digging deeper. If you want to algo trade, learn to create strategies the right way. Don't do an optimized back test and expect it to work. It might, but if you make 100 systems that are all optimized back tests, I think on balance, you're going to lose money. Again, I think the probability is high that you'll lose money. I can't guarantee it. And then as you start to build profitable strategies and start to have some success, you start to gain confidence, and this all builds upon itself. Because you know what? You need confidence to be a good trader. And to think like a trader, you need confidence in what you're doing. So that kind of sums up what I wanted to talk about. Turn it over to questions for a little bit. Looks like we got some time for that. And then I'll, after questions, we'll do about 10 minutes or so questions if we have enough. And then I'll turn it over to a book giveaway. Okay, so let's see here. We've got Rahul asks, are you planning to share a couple strategies or point us in the right direction with some indicators you really find useful? Not in this webinar, but if you go to my YouTube channel, you go to my website, I give away quite a few either strategies or ideas. And then obviously, if you want to go past the free stuff I give away, you can pretty cheaply get a lot of ideas out of my books. And then, of course, what a lot of people who are really serious about this do is they go for my Strategy Factory workshop. And in that workshop, I actually give out 15 or so strategies with the Platinum Strategy Factory workshop. So there's definitely a way to get it. But to answer the question, it's really the best way to do this is for you to actually go and test it. So I could tell you, oh, MACD works great, but maybe that's the way I'm testing it. Maybe I had a certain stop loss with it. You don't know all the details. So what you really got to do is, oh, okay, well, Kevin said it works. I'm going to test it with this and this on this market. And you know what? It doesn't work there. So what's going on? And then you try a different market. That's what you really have to do. And that's what good algo trading is all about, is really testing for yourself. Peter's got a good question. He said, if you're trading 39 systems, what % of them would you expect to be profitable in a normal year? Boy, that's a good question. I have never looked at it like that. I mean, I would expect most of them to be profitable, but the tricky part about that, and the reason I've never really looked at it in depth, is because every month I rotate some strategies out and some strategies in. So I don't necessarily see that, but I definitely expect most of my strategies to be making money going forward. When I share this with platinum students, I think I was able to get a process where I get about 62%, I think was the number, of just random, not random strategies, but all kinds of strategies. I did like 16 million back tests, and I think the criteria I used was able to get like 62% of strategies profitable in the future. And that's over the course of a couple of years, so it would be different for just 1 year. Thomas is saying, is that why we have algos? Because psychologically it's tough to stick with systems that lose 80% of the time. I mean, that can be part of it. You know, algos can take some of the day-to-day decisions out of it, because an 80% loser, I've traded ones like that, and by themselves, they are gut-wrenching. You know, what kind of system was it, you asked? It would take small losses, and it would try to just get on a big trend and ride it for a while. So when it would win huge, but you never knew when that win was coming. And obviously, if you're not trading, you know, if it's not trading every day, for example, maybe it's making 50 trades a year. With an 80% system, you'd lose on 40 of them, and your first 20 trades might all be losers. You don't know. And so that makes it really tough. And so algo trading can help you trade those type of systems, as long as they're making money long term. Also, it's got to be a good risk adjusted money. You know, some of those 20% win systems will put you in terrible drawdowns, so that's something else to consider. Okay, Livio's asking, how do you opt for the best strategies in case of more than two candidates? That's something, Livio, I know you're a Strategy Factory student. We could probably talk about that offline. That's something that's a little more in depth, but there's a couple things I do. So send me an email, I will share it with you. Peter had a follow-up question. How many do you rotate out in a normal year? I probably rotate out of, let's say, 40 systems that I'm trading in any month, roughly. Probably every month, 5 to maybe 10. So, and it really depends on how those strategies do. So let's just say those 40 had a great month. You know, so far, like this year, January's been really nice. I might not change any of them out because they're all performing well. And then I might have a down period where I'm changing out 5 or 10 of them. So it kind of varies. Okay. Hakan is asking, what's your criteria for ending a strategy? Well, this is something I saved for my workshop, but so in fairness to my actual paying students, I don't want to get into too much detail, but I will say the important thing with this is that you have a method to quit a strategy. And most people do not. What they do is they think about all the money they're going to make trading a strategy, but not about what can happen if they lose. And what they end up doing is they ignore bad performing strategies. They just kind of hope it turns around, and then eventually they're like, oh man, this cost me so much money, and they probably pull the plug right at the wrong time, and they make emotional decisions about it because they get sick of losing, right, with a certain strategy. So what I'm saying is the real key, no matter what criteria you use, come up with it before you start trading. That's the key. All right, Thomas is saying, he's asking, if you're running several systems on the same instrument and one gets you long and the other gets short, aren't you just generating a bunch of commissions to get you into no position? Yeah, possibly, but what you're doing there is hopefully your strategies are not correlated. Your performance of those strategies is not correlated. So sometimes, yeah, you get in a trade and you go long with one strategy, and then another strategy 10 minutes later says, oh no, I want to go short, and then you're flat and you've just paid 2 commissions to be flat. But what you're hoping for is eventually that the profit from the first strategy and the profit from the second strategy add up, which is what they'll do. You trade strategy A and it makes $1,000 a month, let's just say. Strategy B makes $500 a month on average. You should make $1,500 a month trading them both together, even if sometimes you're flat. And the best thing about that is when you trade uncorrelated strategies, the equity curve gets smoother, your drawdowns become less. And there's a lot of information on my site about that. So I would recommend you take a look at that. That's also something we talk a lot about in the workshop. Okay, let's see if we have any other questions, just type them in. Livio has a good comment. He says, having fun developing strategies and having a good coach is crucial to not lose the motivation. Yeah, because that's a great point, Livio, and I thank you for bringing it up, because this can get frustrating. You know, a lot of people think, oh, hey, I'll write an algo today and start trading it tomorrow. And, you know, you might go days, weeks, months without creating an algo. It's hard work, especially when you have good criteria. If you have no criteria and, you know, no real process, then it's easy. Of course, you're going to lose money in real time. So that's what you got to keep in mind. So there's a lot to this, and it's not for everyone. Okay, so with that, I want to thank you for attending. If you're interested in my workshop, just go to my website and click on workshop. And if you want to algo trade correctly and build systems correctly, I'm your guy. That's the way I can simply explain it.